I'm Teneale.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. We are back with another episode, and today we're going to break down why the belief that you need to be picking stocks and timing the market is flawed, and equip you then with 10 key principles that are the long-term, tried and tested foundations of a better investment experience. So what about the lucky ones? Because, there's people out there that do manage to achieve good returns with individual stock picking, and it is true that some people do get lucky. But buying and selling at the right time and doing this consistently isn't really sustainable, and all the stats are out there to show why. And when you're thinking about acquiring and growing and protecting your wealth, this shouldn't be based on luck and the risks that can be removed to enable for you to have a more fruitful and, let's face it, more boring experience should be used. So where do people go wrong? Is it chasing the excitement? Is it chasing the thrill? But maybe we'll dive into what you can do to increase your chances of success. So, Teneale, if you want to jump into the first key principle.
Absolutely, Kelsey. Yeah, thanks for the intro there. First of all, you mentioned the keep boring there, and investing is often not exciting when you're doing it right. Putting it away and not looking at it day in, day out, minute by minute, because otherwise you can have some bad habits. But the first key that we tend to talk about a lot is understanding that markets actually work, and having a real belief that markets work. And by that we mean that all information that's already out there is priced into the prices of shares or whatever market it is that you're looking at straight up. And the capital markets there, they represent a collective judgment of millions of investors and all that information that's available and it already being priced in. So rather than trying to go out and outsmart the market and say, well, I have some knowledge that or some idea that I think this stock's going to do better than the other 10,000 that might be available there, just having that belief that the information, you're not going to be smarter than all of that information that's already out there.
And information nowadays is live.
Absolutely.
Right? It's immediate, and therefore share prices, the change is usually immediate.
That's right.
Which makes it even more difficult, right?
Yeah, exactly right, exactly. And I mean, there's certain information that is privileged, but they call that insider information, and that's not the type of information we're talking about here, which is something that's not allowed. We're talking about
illegal.
That's exactly right. We're talking about all that information that can be known about where a company's at, what its profitability figures are. That's all priced into where the stock is sitting at that point in time in markets. So, long-term investors who have invested in this way and had the belief in markets, they're actually rewarded with growth, which is going to be higher than inflation, because we know that shares carry with them risk, and therefore a higher return can be achieved than inflation just by, first of all, having that belief that markets work and investing in markets in a whole. So, why second guess that, I suppose. Yeah.
Yeah. Which leads then onto the second principle to now.
Absolutely, yeah. So then we're talking a little now about the fact that we shouldn't be speculating with our funds. We should, in fact, be investing those funds. And so we coin those two things differently, and we say that, speculating is about going out there and picking stocks and timing markets and trying to do these things to get a return over and above what markets are going to give to me. Investing, media doesn't actually help us with investing, I might add, because they take a very short-term view, and there's a lot of noise out there that there's information that you should be using to go out and say, well, this stock's going to be doing better than the ASX, the Australian Stock Exchange, top 100. And so it can all be very dramatic if you try and pick those individual stocks on that basis. And there's generally a lot of buying and selling and a lot of guesswork that happens in that process. So returns don't reflect that activity, but perhaps this is because of, things like those high trade fees and whatnot that can be involved in this. And it's really about, how many times do you get asked, Kelsey, about what stock's going to be the next one there?
Quite often, but not usually by our clients. But yeah, absolutely, there's people that do ask, what's going to be the best one? And the real answer is, don't know. No one really knows that. And, even if you did know, you might be able to go and do some research on a couple of companies, and you might come across some that might be undervalued, say, for instance, and you might be like, that's the hot stock to go and buy. That's not a long-term strategy with your wealth. You may do well on a couple of occasions. And it's actually quite interesting because in my recent uni assignment, it's post-grad qualification, and same thing, they actually ask you in the assignment to go and individually pick stocks as your first assignment. And the aim of the game is to beat your peers in having the highest return in a 5-week period. And really, and then you have to go and justify why have you bought and sold each individual stock. And at the end of the assignment, you had to write a bit of an evaluation. And of course, for me, it was, this just proves that you can't do it this way long term and consistently.
That's exactly right.
And it's a lot of work. I think the most apparent thing is that is a hell of a lot of work because shares move daily.
Well, they're moving every minute.
Right. So if you want to have a really well-diversified portfolio, which is one of the key things of a good investment portfolio, how are you going to do that but be able to manage on a day-to-day basis absolutely everything that's happening with each individual stock?
And you sort of mentioned a word earlier there that I like, and you mentioned the game in it, because it does. It turns it into a game. It makes it something that's exciting. At one minute I'm happy and I'm exuberant that my stock's doing really well and I'm beating my peers or I'm beating the investors out there, and in the next heartbeat, it's fallen through the floor. And that can happen on a day-to-day basis.
Yeah, absolutely.
And, absolutely the difference there being that we want to get back to those intrinsics of investing and not speculating.
Yeah, which then leads on to the third principle really, and that's take the long-term view. Don't get sucked in by the get-rich-quick schemes because if it's too good to be true, it usually is. And like I said, there's definitely few lucky ones. Like you can win the lottery, but it's not going to be a long-term sustainable option for you to grow your wealth. So what we do know, as you'd mentioned, is over the long term, the capital markets do deliver the returns, but it doesn't mean that they come year on year. And I think that's where people feel uncomfortable when they don't understand that if you're investing for the long term, you're going to have ups, really, really good years in capital markets and some not so good years. So it's in those moments where, you might have 1 or 2 years of negative returns. You've got to understand that that's absolutely normal if you've got the right foundations in your investment strategy. And it's just part of the process, and you will be rewarded by markets over time, but it is time that you have got to give it.
That's right. And emotions can be really hard during that process because, it's going up and down. And so taking that long-term approach is absolutely necessary to be able to get through those different spaces of time, isn't it? Yeah. So I think we've touched on a couple of really key points there, but the next area is a little bit more meaty now. So when we're talking about investing, there are different ways that you can consider, and the fourth area that we're talking about now is considering those drivers of return. So where do returns actually come from? And there's a wealth of academic research out there into what drives returns, because simply just picking a stock and hoping for the best, or picking a series of small cap stocks or of whatever it may be and going, well, I'm just going to hope for the best in this, is not equipping ourselves with the information on where does return actually come from when we are looking under the hood there. And when we think about it, we need to consider there's different dimensions that exist. So when we're in stock market, so we're talking about equities now, there are some known dimensions of return that come to play. And those can be things like the size of the company. So large companies perform differently to small companies. And the large company might be, a blue chip stock, a BHP Billiton with a high share price and some strong dividends, and a small stock might be something with a really low share price that's relatively new to the marketplace and hasn't made its returns as yet. We can also have value companies versus growth companies. So a value company is one where their price on the stock exchange doesn't reflect what they're actually worth on their books, versus a growth company where those two things line up quite nicely. And there's also other price to book equity, profitability. There's multiple layers of these dimensions of returns, and without having a real understanding of those key drivers of returns and risk, therefore, it's very hard to know what you would expect your portfolio to be producing for you relative to the entire market.
That's right. So Teneale, that you were saying there's large stocks and small stocks and value stocks. So if you've got a portfolio that's invested in just large stocks, say, you might get really strong dividends and a steady return, but you wouldn't expect it to, shoot the lights out in terms of some really big returns, because large companies, they've already grown. They're not really expected to grow much more than the size that they're at. And I think that's why when you're building your portfolio and you're looking at what's going to drive the returns, you still have to, yes, you want it to be a steady experience, but you still want to hold those factors in there like the small companies, don't you, so that you've got the opportunity of having higher expected returns.
That's
but
right.
Knowing that it does come with a little bit more risk.
More risk, that's right. Because all these factors, you're exactly right, Kels, are risk factors. And one of the key problem points that we have is when investors get equipped with a little bit of knowledge too, and they go, small cap stocks outperform large cap stocks, so I'm just going to buy those. The inherent risk there is they start speculating. They go, okay, my small cap stocks are going to outperform, but now markets have fallen in the small cap stock space and they've fallen dramatically, and so now I don't feel good about it, I'm going to get out of it. So again, like you hit the nail on the head, that if I know these different dimensions, I then need to create a portfolio that takes me through different periods of markets, and that might mean having diversification across all of those different dimensions. Yeah. And we also have the same in the cash markets, so fixed interest type markets. There's two different types of risk and return factors there. We have term risk, which says that if I'm locking my funds away for a longer period of time, then I should be rewarded with a higher level of interest rates on that, return on that. And there's credit quality risk. So if I'm investing with a major financial institution or the government, perhaps that's a lower risk to me than investing with a small credit union or the likes, and therefore my return would be expected to be higher with a lower credit quality risk. There's also key consideration, things like currency and whatnot, that we won't get into in too much detail, and we do have another podcast that we jumped into those areas of term and credit risk specifically for cash. So we might leave it on that basis and keep it quite high level, and just understand that there's different dimensions that we need to be considering to understand where that return's actually coming from. But if we then take that back out to the big picture, Kelsey, maybe you can talk through, the next key area here for us on how to build those portfolios then.
Yes. So number 5, a key principle is smart diversification. And I feel like diversification is such a buzzword.
It is.
And everybody hears it when they speak about investing and like, oh, I know what that means. But when we're talking about smart diversification and what that really, really means, what does it mean to be diversified? You've really got to think about, if you have, let's say, 100 stocks in your portfolio, does that mean you're diversified?
Well, I think this one here always gets me, because if we referred back to some textbooks even, they quote a number of 20 stocks.
Yes.
And do I think that 20 stocks is a diversified portfolio in its own sense, in its own right? Absolutely not.
No.
Because you've probably got 20 stocks and you've picked them all, and they're all banks and research companies or wherever the case may be. You've picked 20 stocks. That's not diversified in its own right, is it, Kels?
No, that's right. So let's say that these 100 stocks, say, were 100% in the Australian share market. That's not diversifying smartly. You might, of those 100 stocks, have lots of different sectors. So, you've got banking, you've got pharmaceutical, you've got, mining, you've got all of that in there. So you're diversified across sectors. But there's another layer to that. You're 100% in the Australian share market. And that's only roughly 2% of world markets, right? So that's not really true diversification. If you want to capture the returns that are out there for investors, and thinking of the bigger global markets like the US and so on, if you also diversify across those, that's probably doing it in a little bit more smarter manner, because as you can imagine, different share markets in different countries have, they act differently at different times depending on, lots of different factors that get priced into that. And there's lots of ways then that you can think about diversifying. So country, the industry, as I'd mentioned, and you want to be smart about this, but it doesn't mean that you shouldn't have high weighting in certain areas as well. And I think, people go, well, I'm diversified, but you can also miss out by being too diversified, right? Is that possible, Teneale?
Yeah, well, so just to back up, there was a key point that you were making earlier about the different markets, right? And so one thing I wanted to point out for our listeners is that there is a difference between the assets that you're investing into and those sectors, those asset classes. So, you're speaking about the fact that there's diversification in your Australian share portfolio by having 100 stocks or 200 stocks, so however many you have. Those asset classes is really the key then that you're talking about, getting those diversification across those different areas. So
that's right. So, there's the share market. So you might choose a weighting to that and then diversify within that asset class. But you've also got global share markets, you've got emerging markets, you've got property markets, and obviously your cash and fixed interest type instruments as well. So yes, you're right, across the asset classes that also needs to be considered. So I think that I want to take it away from the buzzword of diversification because what does that really mean, and actually go, well, there's lots of ways that you can diversify, but to do it smartly there's lots of different layers that you have to think about. And so that's pretty much diversification in a nutshell. So the next one, number 6.
Yeah. Well, now we've got this portfolio, right? So we've picked our assets and our different asset classes, and we understand that markets work. We're looking at things over the long term. The next thing that we find, for myself, I see a lot of investors can go wrong in this space is the temptation to time markets. So now I'm ready to invest. I'm going to put $50,000 into a portfolio. The first question might be, should I get in now because markets have been going down in the last week? That's a timing decision. Now we're saying I'm going to take an expectation of what's going to happen from tomorrow onwards, and we don't know what's going to happen from tomorrow onwards, but we know the best way to get a good investment experience is to get in as quickly as you can once you're ready to and you've got your funds available, and then to leave it there for the long term. So some people think that, when a recession's happening or a downturn's happening, maybe it's time for me to get out now. This then goes back to that comment we were talking about with emotion coming into play. So it's quite easy for financial advisors to sit on the other side of the table and say, markets are in decline, and now is the best time for you to be holding your assets, continue holding them. And if anything, if you've got further funds that you want to be investing, if we know that the idea is to buy low and to sell high, you should be getting in and investing at this point in time. When emotion comes into play though, and that's my own money, and it feels quite uncomfortable, those times of recession where markets are getting low, the avoidance of getting, not going in market timing becomes really important. So
this one's interesting to me, particularly when we think about recessions, because I actually had someone say the other day, it's all a little bit uncertain at the moment. I really feel like something bad's coming. There's going to be a recession. You can't have all these factors come into play, wars, pandemics and all these things, and something bad not happen in share markets, because they've been going relatively well over the past couple of years, right, for the most part. And I said, well, okay, if we think that's happening, should we just get out of the market now whilst it's good and then just wait for the recession to happen and then we'll get back in? Okay, but what if that doesn't actually happen? Because at this moment in time, we're not there. Markets aren't declining. We're not in a formal recession, and that's not what's really happening. So if you take that approach, you time the market. Let's say you said, this is what I'm going to do, and I'm going to sell my assets, and you're now sitting in cash. First thing being, what if the recession doesn't happen 2, 3, 4, 5 years from now, and you've just got your money sitting in cash? That's a huge opportunity cost, because during that time, markets are going to deliver returns, and you're going to miss out on those by not being there. And second to that, let's say even if there is a recession, so you're still trying to time there is a recession, great. So you get affirmation that I was right, I pulled out at the right time. But then when are you comfortable enough to get back in? Because the next part of that process is going, when is it going to be low enough for me to feel like it's the right time to buy in? And
this happened a lot post the global financial crisis. So earlier on in my career, I saw a lot of cases where we had new investors coming through at the door, and maybe it's their superannuation or whatnot. They'd made a decision to sell out of those assets and put them in cash during the GFC, because it was just such a huge event and it caused so much emotion in them. And they felt comfortable to do so because there was a period of time while those markets were just not going through their recovery. It was taking a long time. But the risk and the detriment that can cause to a portfolio, because you don't know when to get back in, and most typically it's when things start to pick up again. So now, is that really going to be my best point of getting back in when markets have already recovered and I've missed some of those good returns?
Right. And how do you feel about that as an investor? Because there's every possibility there that you miss buying it when markets are down and they start trending upwards, and you go, well, now I don't feel good about what I've done, so I'm not going to buy in now either, and I'm going to wait for it to go down again. And then you're in this vicious cycle. And on the contrary, when we think about individual stocks as well, and we see this often still to this day, you have people that have individual shares that they've held for many, many years, and it was a bad decision, and the price isn't where it was when they purchased it, but they can't let it go because I'm just going to wait until it comes back. But when you're thinking about individual shares, it might not come back.
That's right. I mean, you have those different sectors that just, if we thought that print media was going to be the thing of the future, that might have been the case 30 years ago, but now we know that the assets in those classes, they don't have the same potential as something like a FANG stock or whatever the case may be in the current climate, and that changes over time. It's very cyclical. So definitely the key throughout all of this is, if we bring it back to that high level, is it's not about timing. It's not about when to get in and when to get out. It's about being invested over time.
Yeah, and which brings us to the next principle, number 7, which is manage your emotions. And I think we've just spoke about some of that now in the last one, because the timing of the market has a lot to do with emotion. But let's not disregard the fact that it's hard when you're thinking about your money and what you want to achieve and what it might be taken away from if it doesn't go right. It can be an emotional process. So, we're driven that way, particularly when we think about money in terms of, impulse spending. Money drives us emotionally in many, many different ways. And, that can happen when you're investing, and we do see that happen. It doesn't really sound smart, right? Emotional investing doesn't sound very good at all. And that's really based on the principles of greed and fear. So what we was talking about, Teneale, greed, you're buying in when markets are high, and then when markets are going down, you're getting quite scared, and then you're selling out a low, and it's just the cycle. And herd mentality comes into that too. Everybody's saying, market's going really well, I'm buying in. You jump on the bandwagon. That's not really a smart decision. It's purely emotional based. It's not too logical. And you have to think about all the other principles that we've spoke about today. And like I said, it's really normal for us as humans to do that. But you've got to be rational, and if markets are down and you're seeing your capital drop by 20%, but it's okay because you're really well diversified, it can be uncomfortable, but you really do have to ride that out. And I think a good advisor will help you through that process. They'll prepare you ahead of time for what to expect, but when you go through those times, they'll be the person there that you can lean on to kind of talk those things through and feel a bit more comfortable through those cycles.
Yeah, it is that sounding board, isn't it? Because like you say, when markets are down, emotions are high. I don't feel comfortable with this. I'm losing my shirt. I need to get out. A good sounding board will be telling you why. What do you need the money for at this point in time? If your situation hasn't changed, and you can now buy 10 apples for the price of what it cost you for 5 apples last week, why not jump on that bandwagon? Or conversely, when markets are high and you go, oh, this is great, I should be buying in more at this point in time. Do you need to be overcommitting yourself? Should you be buying assets that are more expensive than they were previously? Or is there a more staggered approach that we can take to this so that you're just doing this in line with your own strategy and what works for you?
That's right. Yeah. So then on to the next one, and I'll keep this one really high level because we have again touched upon it, but the 8th principle is look beyond the headlines. We'll often see headlines, retire rich, sell stocks now, or looming recession. Another one we've seen quite recently, housing market boom. All of those things, they sound quite tempting, but what that happens is that you're tempting to fate, and it's fads. It really is fads at that moment in time. And I think you just need to consider, back to the other principles, does this align with my long-term goals? Is this a short-term decision that I'm making here? Does it mean I'm going to be diversified? And just try and dampen the noise. Watch the news, hear the media, but don't align that with your investment decisions.
And social media can make this particularly hard too, because it can feel like it is a matter of fact when a lot of the information out there is just opinion. And we should really be putting that overlay on our thinking when it comes to investing and a lot of broader categories. But if we take that approach and say, well, this is an opinion, that's been put out there. And if I take that opinion for what it is, and then I go and do my own research with specialists and with that knowledge, get that real good investing knowledge, I can then start making those smart choices when it comes to investing, rather than just being driven by the emotion that can be created by those headlines.
And the headlines, they don't really give you much context. So when it comes up on the news and they do their daily segment on share markets, ASX stocks tumble. Relative to what? From yesterday's price or 5 years ago?
That's right. But emotions sell. We know that that's the case. We know that there has to be an emotional trigger that's generated for the media to be able to get people to buy into what it is they're talking about, what they're selling.
Yep, that's exactly right.
If we go back, he's just said emotions are not the best way. We shouldn't be emotional investors, and that's hard. You've got to have those sounding boards. You need to have that ability to pull yourself out of that space and make informed decisions, rather than be letting those emotions take the driver's seat.
That's right.
But if we assume that now we can really understand, the drives of returns, that we're investing for the long term, we're diversified, we've got all of those areas covered. One of the second last principle we'll talk through is about the control on things like costs. So keeping costs low when I'm investing is a really great way of giving myself a better overall outcome, because I like to explain it this way. If you can reduce your costs by 50 basis points, that's 50 basis points that you don't need to go chasing in additional returns. It's a guaranteed win for you. So there are a lot of myriads of investment products out there, and some of them will be high cost, some of them will be low cost. But if you really can get in there and find true products that have a low cost, you can really minimize the risk of your wealth being eroded because of those costs.
So just to talk on what triggers some of those costs, Teneale. So if you've got an investment that's really, really high cost, so let's say you've got a fund, so you're not buying individual stocks and shares, but you've got a fund that's really high cost. That's because of all the buying and selling and the expertise that you're paying for, right? And then you have to evaluate, well, are they over the long term delivering that expertise and value in addition to the costs that I'm paying for this, right?
That's right. And especially in that space of speculating and actively trading those assets, there's a lot of evidence that shows that those high cost funds that are in the speculative space, they don't tend to outperform their relative benchmarks on the long term basis. And therefore, if I'm getting a market like return, but I'm paying an extra 50 basis points or 1% or whatever the case may be, I am losing out.
Yeah.
I'm not doing better than what I would have otherwise been just taking a broad market approach.
Yeah. And that's where it comes down to. It doesn't need to be exciting. It needs to be boring, and that's where you'll probably keep your costs lower too.
That's right. That's exactly right, Kels. So, and if we summarise this then and say that for our last point, the keys here are that if I can focus on what I can control, because there's a lot of things that we can't control. We can't control government policy. We can't control, pandemics. I can't control what's happening with inflation and interest rates. But what can I control? Well, first of all, everything that we've just gone through today puts a lot back into your circle of control. How diversified my portfolio is, what level of costs I'm willing to spend, taking a long-term approach, all those key factors, they are within my control. What else is in my control is setting myself in place a plan, doing that with a good advisor or with somebody who has specialist knowledge in the areas that I don't, if I don't have specialist knowledge in some of these areas, and setting that it's sound investment plan that fits both your needs, your risk tolerance. It's structured well based on those dimensions of return. It's going to be diversified globally across all those asset classes, and we're managing those costs and taxes. Then staying disciplined. The hardest step then is just to stay disciplined to my plan. So if we draw that circle of control, understand what's in it, what's outside of it, that will give us a much better experience, particularly over the long run.
That's right. So that's us for another podcast. And if you have enjoyed this episode, it's left you wanting to know a little bit more about the investment space. And tune in next time where we deep dive into the technical side of the investment world with a very special guest. And if you have enjoyed the content, please don't forget to subscribe, share, and leave us a review. And we'll join us next time.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.